Good morning, multi-bagger hunters, and welcome to the show. It's Friday, October 24th, 2025, and we've got a fascinating set of AI-generated insights for you today, compiled from all the market chatter and data we scooped up yesterday.
That's right, Ethan. Our systems processed a substantial volume of social media discussions, flagging a wide range of stocks. It's a real mixed bag, frankly, with some very promising signals from established tech, but also a lot of high-risk speculative plays that, well, demand a very close look at the fundamentals.
Absolutely. The sentiment is, quite dynamic today. We're seeing strong bullish energy around some of the big names, really pushing the boundaries of innovation. But then you have the more speculative corners of the market, which are, to put it mildly, generating a lot of buzz, but not always with the underlying financial strength to back it up.
So let's jump right in. Kicking things off with the big players, we saw a lot of excitement around Alphabet Inc., Google, today, specifically with their Willow quantum chip and the whole AI King narrative. People are really bullish, seeing it as fundamentally undervalued and leading future tech.
Well, Ethan, while the community sentiment for Google is indeed strongly bullish, driven by the quantum chip breakthrough and the AI King claims, the KPIs do reflect a somewhat elevated PE ratio of around 27.02. However, I have to admit, the revenue growth at 13.8% and net profit margin of over 31% are exceptionally robust. This isn't just hype, there's solid profitability backing those long-term tech plays.
Exactly. And that 13.8% revenue growth for a company of Google's size, that's just outstanding. It really reinforces the idea that they're effectively expanding and monetizing these innovations. So, combining that strong community sentiment with the solid financials, I think Google is a clear buy today. They were a stay away just a couple of days ago, so this is a significant shift in AI-generated insights for us.
I concur. The financials are too strong to ignore the long-term potential, despite the valuation. Now, moving on to another tech giant, Microsoft Corporation, MSFT. Our AI models also flagged strong bullish sentiment for them, with analysts touting their AI and cloud momentum.
Oh, Microsoft is looking incredibly strong. We're seeing mentions of their active involvement in quantum computing, their strong AI and cloud momentum, and even analysts calling it one of the last of undervalued AI stocks. They're investing in microfluid cooling, they're developing the Majorana 1 chip. It's all about future-proofing and dominance. Their Q3 earnings are just around the corner, too.
Ethan, the numbers certainly back that optimism. MSFT boasts an impressive 18.1% revenue growth, a staggering 36.1% net profit margin, and a 33.1% return on equity. These are exceptional KPIs, demonstrating a highly efficient and profitable business. Even with a PE around 38, these metrics scream financial health and strong management.
Given that and the consistent bullish sentiment across several discussions, MSFT is another strong buy for us. It's a repeat of our previous buy ratings and certainly an upgrade from the cautious buy it recently held.
All right, let's talk NVIDIA Corporation, NVDA. Our data shows a strongly bullish outlook with discussions centered on their strategic partnership with Intel.
Yeah, the community analysis points to NVDA's collaboration with Intel as a masterstroke. It's about securing future manufacturing capacity, expanding their CUDA ecosystem, and really solidifying their dominance in the AI and GPU markets. We're talking about massive long-term growth drivers here. Analysts are still bullish despite some AI bubble concerns.
From a KPI perspective, NVDA is undeniably powerful. A 55.6% revenue growth is phenomenal, and a net profit margin of 52.4% is just exceptional. That said, a PE of around 51.75 is high, reflecting significant market expectations. However, given their sustained growth and operational efficiency, it appears warranted for now. For NVDA, the growth potential and strategic moves are too compelling to ignore. We're classifying this as a buy. It's been a mix of buy and cautious buy recently, so we're leaning into the bullish sentiment today.
Fair so much. Now, let's shift gears to advanced Advanced Micro Devices Inc., AMD. The sentiment is a bit mixed, with some acknowledging their competitive strength in GPUs, but also some significant red flags popping up in the data.
Indeed. While some commentary suggests AMD is gaining ground in GPUs, my primary concern is the valuation versus current profitability. We're looking at a PE ratio over 140, a price-to-book ratio of 6.38, and most critically, a negative operating margin of minus 1.27. This means their core operations aren't profitable, and their debt-to-equity ratio is very high at 6.51. Strong revenue growth of 31% is positive, yes, but those other numbers indicate a significant risk at this valuation.
Well, growth stocks often trade at a premium, and AMD has been making some strong strategic moves, like Supermicro expanding with their APIC processors. But I hear you, that negative operating margin is a tough pill to swallow.
Given the extremely high PE, the negative operating margin, and high debt, it's just too risky for me. For most investors, AMD is a stay away. It's been mostly stay away in our previous ratings with one recent cautious buy, but the current data brings it back to a clear stay away.
All right, moving to Tesla Inc., TSL. Some individual holders are happy, saying they're enjoying recent gains. That's often a good sign of community confidence.
Ethan, I have to challenge that. While some are glad they held, the dominant sentiment from the most upvoted comments is quite bearish, predicting poor future earnings and skepticism that the stock is driven by hype rather than fundamentals, expecting it to be in the red. And the KPIs fully support this bearish view. We're talking an astronomical PE ratio of over 317, a negative revenue growth of minus 11.8%, and an extremely high debt-to-equity ratio of 16.8.
Oof, negative revenue growth really undercuts any growth story, doesn't it?
Absolutely. Plus, recent news confirmed Q3 earnings missed expectations, leading to a heavy sell-off. The fundamentals simply do not justify that valuation. TSL is a clear stay away today. It's consistently been in that category with one recent speculative gamble rating, but the current data brings it back to a definite stay away.
Next up, DQBT, quantum computing, always a hot topic. We saw some posts hinting at the U.S. government exploring equity investments, which could be a huge catalyst, turning it into critical infrastructure.
While that specific post showed strong bullish sentiment, other discussions directly refuted those government talks as complete bullshit, and the KPIs align with the skepticism. QBT is deeply unprofitable, with an EPS of minus 1.13, a negative operating margin, and an extremely high price-to-book ratio of 15.2. A high debt-to-equity ratio of 5.7 only adds to the risk. This looks like a classic meme stock that thrives on unconfirmed rumors.
So the hype might be there, but the foundation isn't.
Precisely. The market is pricing in immense future growth that is simply not supported by current operations. QBT is a stay away. It's consistently been rated as stay away.
It seems similar to Rigetti computing, RGT, also in the quantum space. We saw some users celebrating gain porn on their RGT calls, saying they doubled down and made significant profits. That shows real community enthusiasm.
Ethan, that gain porn post highlights successful speculative trading, not necessarily a sound investment. Other more critical posts directly accuse management of a coordinated cash grab through insider selling, refuting positive spins from the media. The KPIs are equally concerning. Negative revenue growth of minus 41.6%, negative EPS, zero net profit margin, and an extremely high price-to-book ratio of 23.16.
So even with that exciting short-term win, the long-term picture is grim.
Exactly. Insider selling accusations combined with such weak fundamentals and an extreme valuation make RGT a firm stay away. It has consistently been rated as stay away, with one prior speculative gamble.
All right, let's talk IREN Limited, IREN. Some analysis suggests it's a power-first operator scaling into becoming an IaaSSP with a huge price target, pivoting from mining to AI cloud contracts. Sounds like huge potential, right?
That's a highly optimistic narrative, Ethan, but the most engaged comments directly dispute IREN's full-stack claims and point to a lack of concrete AI partnerships, calling the transition speculation. The numbers are concerning, too. A PE ratio of 143, a PB of 7.93, and yet only 2.23% revenue growth. This signals a severely stretched valuation based on unproven future performance.
So the market's getting ahead of itself on this one.
Massively. High valuation with modest growth and speculative pivots is a recipe for risk. IREN is a stay away. This is a downgrade from its previous buy rating.
How about WebBull Corporation, Bull? There was a YOLO post claiming it's undervalued.
Well, undervalued is a strong claim, but the sentiment is overwhelmingly bearish, with users questioning any catalyst and pointing to stagnant performance. The KPIs are dire, frankly. Bull has negative net profit and operating margins, and EPS well into the negative, and an extremely high debt-to-equity ratio of 15.01. It's trading near its 52-week low. These are not signs of undervaluation. They are signs of a company in financial distress.
So,
Invest as buy. Make sure to investigate Alphabet Inc., Goog, Microsoft Corporation, MSF, and NVIDIA Corporation, NVDA. Invest as cautious buy. None. Invest as speculative gamble. D, QBTS. And that wraps up another episode of the Daily Hunt for Multibaggers.
remember, this podcast is for informational and entertainment purposes only. The content is generated by artificial intelligence and does not constitute financial advice. Listeners should conduct their own research or consult a licensed financial advisor before making investment decisions. We are not responsible for any losses incurred. The market is a wild place, and knowledge is your best asset.
Thanks for tuning in, everyone. We'll catch you next time for more insights on the Daily Hunt.